last section of homework 10, we're going to talk about mortgages. Mortgage section, it's a little more to it than the installment buying, but not a whole lot. We're going to, again, instead of using the tables, instead of using the formulas, we're going to use a table. There is a table in your textbook, and I just copied this one straight from your textbook. So the fact that this one is circled is from one of the examples in your text, so don't worry about that. The difference in this chart is we do have the percentage rates. So the percentage rate, annual rate, APR of your loan across here. We have the number of years of your loan, and in here, instead of the finance charge, we have your monthly payment. And this is a monthly payment per $1,000 of loan. So if you had a $2,000 mortgage, of course that's ridiculous, then you would multiply 2 times this value. If you had a $200,000 mortgage, then you would do 200 times that amount to get your monthly payment. Going to be several questions you can be asked, so we're going to look at an example, and in one example we're going to go through and find all of the things we could talk about, and the problems that you'll actually do won't ask you for all of these. Each problem will ask you for parts of this. Again, you can use the chart in your book, or you can get one from online or whatever. While you're doing your homework, a piece of the chart will be included in the problems that are on your quiz and test, so that you do not have to refer to an outside table for those. Okay, let's go ahead and look at our example. The Smiths, see, that leaves us wide open. The Smiths buy a $160,000 home. Their loan requires 10% down payment. And to get 6.5% loan, they must pay down 2 points. Points are percentage of the loan amount, so they'll have to pay 2% of the loan amount in order to get 6.5% loan. Sometimes you have a choice of the number of points, and sometimes you don't. Sometimes there's no points. Sometimes if you have choice, you pay more points, you get a lower interest rate, but you've got to pay that up front as a fee. And sometimes they'll let you actually incorporate that into your loan, but not always. Okay, they're going to have a 25-year loan. Okay, so let's see all the things that we can find out about this. First of all, what's the down payment? The down payment is 10%, so I'm going to change the 10% to a decimal and multiply that by the cost of the home, which is $160,000. When you multiply that 10% of that is $16,000. So their down payment must be $16,000. In the past, there's been loans where you could have a lot smaller down payment than that. This conventional loan typically has a 10% down payment, sometimes 20%. In times of financial stress, they may be even higher. All right, so what is going to be the loan amount? Well, the house costs $160,000, and they're going to put down $16,000. We just subtract to find the loan amount, which in this case is going to be $144,000. So their loan amount is $144,000. So if they're paying points, in this example, points fee for 2 points, so they're going to have to pay 1%, and remember 1% with the decimal 2 places is 0.01 times the amount of their loan, which is $144,000. So their fee for the points will be $1,440. Okay, let's find their monthly payment. Their monthly payment, we said they're going to do 25 years at 6.5%. So we'll scroll back up to the chart. 25 years. So here's 25 years, 6.5%. So they are going to pay $6.75 for every 1,000 of the loan. Their loan is $144,000. So how many thousands is that? This one's pretty obvious because I said $144,000. So they're going to make $144,000 loans, if you will. So we've got to multiply. What was the price I said? $675. So they've got to pay $675 times 144, because that's the number of thousandths. And if you put that in your calculator, 6.75 times 144, you get 972. So their monthly payment is $972. How much they have to pay each month. The number of months, and this wouldn't typically be a question, but it's going to help us for the rest of the problem, so I'm going to go ahead and state it like a separate question. There's 25 years, and there's 12 months in each of them, so we're talking about a total of 300 months. So they're going to pay $972 for a total of 300 months. Okay, so how much are they going to have to pay back? The total payback amount And often, if you have a mortgage, and for some reason you would come into a lot of money, like win the lottery or something, you would have to pay penalties to pay your loan back early. So you want to check on those kind of things when you get a mortgage. And you also would sometimes like to pay ahead a little bit. So if you could just pay even $1,000 a month, that's going to save you a lot of finance charge. But some loans don't allow it. So you need to check on that kind of thing when you're getting a loan. The total payback amount, well, I'm going to be paying $972 for 300 months. So I'm going to pay $972 for 300 months. That's writing a lot of checks. So the total I'm going to pay, my gosh, not $291,600. $291,600. It's how much I'm going to have to pay back the mortgage company. Okay, so what was my finance charge? Well, $291,600. How much I'm paying back when I only borrowed $144,000. So that's going to be what, $147,000. $140,600 in finance charge. So take the amount you pay back minus the amount you borrowed, same way you did for the installment loan. Total paid for the house. Assume you didn't make any payments, extra payments. Just made these regular payments. We're going to put down in the down payment $16,000. I'm going to put in the points fee, though there'll be other fees too. You'll probably get a house inspector, and sometimes there's a title search fee and various other fees. But we're just going to talk about these. And sometimes if your credit's not good, you also have to pay private mortgage insurance. In fact, your monthly payment really won't be $972 because they're going to add in to the amount you pay each month. That's just for the principal and interest. They're going to add in your insurance, and they're going to require you to have insurance on your house because if it burns down, they really own it, a big portion of it. They want their investment safe. So you're going to have insurance, and of course your taxes. Especially in Virginia, you're going to have taxes on your home, so you have to pay those too. And then at the end of the year, they will keep those monies in what they call escrow for your insurance and for your taxes, so that they can pay those for you. So that helps many home buyers, that they don't have to save up that money to make that yearly payment for their taxes and their insurance. So the mortgage company is really doing them a favor for most people, breaking that down into 12 payments for them. If you don't have good credit, they may also require what's called private mortgage insurance, and that's in case you default on your loan. And we'll not talk too much more about that now. Okay, so we've got what? $309,040. So in the end, because I had to borrow money, how much did I end up paying for this $160,000 home? $309,040. That's how much I ended up paying. Now, the first month, I'm going to pay in principal and interest $972. How much of that first month will actually be towards the principal? How much of first month's payment towards principal? And this number will go up every month, so that at the beginning of your loan you are paying lots and lots of interest. And the good thing about that is you can take that interest off on your taxes if you itemize. Towards the end of your loan, you will be paying mostly principal and very little interest. For that reason, if you're towards the end of your loan, you want to make sure you make all your payments. They're much quicker to close down a loan near the end because they're not making so much money off of it. But by that time, a lot of years have gone by, and typically salaries and so forth have gone up, so it's easier to make your loan payment at the end of your 20, 25, or 30 years than it is near the beginning. Okay, let's see. How much of the first month's payment towards the principal? Well, our interest is 6.5% per year. So that's APR. We want to divide that by 12 to get the month. So 6.5% divided by 12 would be like our monthly interest rate. And then we're just going to use similar to the simple interest. At this point, I still owe all of the loan amount because I haven't made any payments yet. So I owe $144,000. That first month, the interest is going to be 0.065. Remember, you have to move your decimal 2 places to the left. And I want to divide by 12 because it's going to be the monthly rate. So let's, come on. Let's do that. That's going to be 144, 1, 2, 3 times 0.065 divided by 12, $780. So that first month, I'm going to be paying $780 in interest. Mostly interest, because how much was the payment? The payment was only $972. So 972 minus 780 is $192 that I'm paying in principal. Principal paid the first month. So at the end of the first month, how much will you still owe on the house? After one payment. Well, now your loan amount is going to be $144,000 minus the whopping little dent that you put in the debt. 144, 1, 2, 3 minus 192. $143,808. So you still owe that much. And if you want to know how much The second month's principal, you would do the same thing. You do the 143,808 times the 0.065 divided by 12. And you can see, because I'm starting with a smaller number, the amount of the interest is going to be lower. It's not that big of a difference, but it will slowly go down over time. So, it sounds scary to think about all this money you spend in buying a house. But historically, buying houses and land has been a good investment in our society, and hopefully will continue to be. Okay, that's the end of homework 10. Homeworks 11 and 12 will deal with statistics.